if you go back 5 years, it was a risk asset. There was nothing else about it, right? It was every uptick and downtick was with the stock market. Much more recently, we've seen a divergence in that. For instance, at this low, this is where the bank failures occurred, right? So we saw Bitcoin actually ripping higher when U.S. banks began to fail, and there was questions about deposits. That's really good to see. That tells you people are using it as a safety net. The other thing here was the BlackRock, this little low pivot, the BlackRock spot ETF caused this latest move. So I think you're starting to slowly see it morph, but it's a morphing that's going to take years, not weeks or months. And investors just have to be patient. Over time, as it becomes more and more accepted as a digital gold, then it will be treated as a digital.
Bitcoin's current price stagnation around $26,000 has brought its velocity to multi-year lows, reminiscent of the period before its 2020 breakout. This static state indicates reduced trading motivation as major investors withhold movement. This situation has dual interpretations: positive due to whales holding on to Bitcoin, or negative due to limited transfers to new investors. Despite this, oversold conditions persist as indicated by Bitcoin's daily RSI, potentially reflecting an awaited resurgence of investor interest that previously catalyzed Bitcoin's ascent past $20,000 to new all-time highs. Now, let's continue our enlightening discussion with Gareth Soloway.
You can see here is that on the Bitcoin chart here, we tested that area right here, same area right over here, and eventually it failed and came back in. And then we had this upsloping trend line here, which again, it's a trend line, meaning trend. And if you just connect all of these lows, that gave you that trend line. We've broken that. So we are getting a little bounce today along with gold. So that's interesting to see. But unless we recapture this area and then take out this 31,000 area, to be honest, I would remain very careful on Bitcoin. I think overall, the trend is going to continue down, more so not because of anything to do with Bitcoin. And I think for Bitcoin maxis, this is the hardest thing to understand, is that Bitcoin to me is a genius thing. It makes so much sense in every which way, but it still conforms to the laws of risk assets until it becomes a non-risk asset. And that means that if I'm right and the stock market has 20% downside from here in the next 6 to 12 months, it's going to be hard for Bitcoin to withstand that sell pressure in the overall markets. And that's, to me, where it could come down. The next level's at 25, then we have major support at 20, and then ultimately back to 15.7. So I'm still in the camp that until we see the stock market really flush out, Bitcoin will remain vulnerable until that point, or until the Fed start printing aggressively again. So I think there's this divergence between what we're being told in terms of some of the stats and what really the underlying economy is showing us from like the perspective of a retail investor or just someone in the population. And what I mean by that is that you have data that is starting to show weakness, but the jobs numbers are still strong, but people are getting hurt because of inflation, because of other factors. And so you're still seeing this kind of chase for return in the stock market, but for the most part, people are now beginning, at least according to me, they're starting to be seen as kind of troubled. Like they're starting to experience the pain of running out of savings from COVID. And you mentioned the NASDAQ's outperformance, and I think a great stat here is that if you look at what the NASDAQ 100 is up, I think 36% year to date. If you take out the top 5 stocks, the Amazons, the Nvidias, the Microsofts, the Apples, and so forth, the NASDAQ would only be up about 13% on the year. So it's very much concentrated, contrary to what a lot of people will tell you. And that is, to me, a warning sign for the overall market as well, that it's so concentrated in a couple of names. If you go back to 2000, before the dot-com bubble burst, and once it started to burst, we saw the exact same thing. Everyone started calling for a soft landing. Everything was going to be okay. The same thing occurred in 2007, just before the financial recession. And so this is a very common thing where initially people expect something dramatic. Everyone's hearing, we saw the inversion of the yield curve, and everyone immediately thought recession. But interestingly enough, with the inversion of the yield curve, the recession doesn't occur until the uninversion. All right, but people expect it as soon as they hear the headlines of, we have an inverted yield curve. And so past recessions have proven this. And again, we're in that same situation where initially at the start of 2023, everyone was saying, wow, this is going to be a horrible first half. It turned out to be a great first half. Now no one is thinking it's going to be horrible. And that's usually when the bad stuff comes. So I do think the second half is going to be rough into 2024. And I think, remember, the Fed has hiked rates so much. This is the most aggressive hiking they have ever done in the history of the Federal Reserve. And there's a lag effect. There's a 6 to 12 month lag. And so you can't say that what we're experiencing right now is exactly where interest rates are. You have to give it about 6 to 12 months from now. And then you can say, okay, this is the economy under 5.25% to 5.5% Fed funds rate. So in this situation, there's a couple things I'm watching. One is the NVIDIA earnings that are just about to come out. They'll be out, obviously, by the time this interview gets published. But if they blow it out of the water and the stock market has a big rally, I wouldn't be surprised if it pushes the Fed to be more hawkish in Jerome Powell's speech on Friday. And the thought process behind that is if the stock market rallies significantly, the wealth effect propels investors to spend more money, which then creates potentially inflationary situations. So the other way could also happen if we see a big drop in the markets, the Fed may be a little bit more dovish on Friday. Based on what we're seeing from Fed funds expectations, the Fed is now not expected to cut rates until mid-2024. However, the question, and we'll find this out on Friday, is does Jerome Powell guide us to expecting another rate cut, another rate hike this year, or just continued pause? And I really think they're probably on the fence. The minutes from last week were very hawkish, but I do think, again, they're starting to see the breaks that I'm seeing in the data. For instance, I just heard this morning that jobs numbers are going to be revised down 300,000, I think 310,000 from non-farm payrolls. And so that really wipes out the gains of the last month, and that has to be something that we start to pay attention to. Yeah, it's an interesting situation in China because, they didn't get the same bounce from when the lockdowns kind of, ended there versus what the U.S. saw. The U.S. saw this massive spending spree after all this money had been saved. In China, we didn't see that. And I think the key here is that their economy has been kind of teetering for a long time. They've been plugging holes. Their real estate situation has been really bad for really the last 10 years, with whole cities in China being built up with no one living in them. So I think there's the bigger issues there of how they're going to get through this. I would say this is that China can potentially be harmful to the global economy, but I also think that the global economy has been diversifying their supply chains, their imports away from China because of the risk of Taiwan and what's going on there. So I do think China plays a big role. They're the second biggest economy in the world, but I also think that it's not as big a role as it was maybe 2 or 3 years ago in its impact on the global.
Don't forget to join us as we explore the unfolding events. Rich Dad. Poor Dad author Robert Kiyosaki passionately advocates for silver investment, highlighting its affordability compared to fake dollars. He emphasizes silver's potential, being only 50% of its all-time high, with high demand in green energy sectors. Kiyosaki sees silver as real money, contrasting with the unbacked US dollar. His previous forecasts include gold at $5,000, silver at $500, and Bitcoin at $500,000 by 2025. He also projected in a world economy crash scenario, Bitcoin could reach $1 million, gold $75,000, and silver $60,000. Economist Peter Schiff warns of full-blown financial crisis hitting U.S. economy before Fed reaches inflation target. The U.S. dollar's dominance in global payments has strengthened, according to data compiled by global financial messaging service SWIFT. The share of SWIFT FX transactions involving the U.S. dollar rose to a record 46% in July. In addition, the share of the transactions involving the Chinese yuan has increased.
Gold certainly hasn't been flashy this year. Last year was a much better performer in terms of its upside outperforming the stock market and Bitcoin. In this situation, it's been more quiet, right? You haven't really seen a lot of price action. If you go to the beginning of 2023, I think we're slightly positive on the year on gold, but it's not been the amount of upside that we've seen in Bitcoin or in the stock market. But I will say this, in terms of risk versus reward, I think it's still a top play here for an investor. So you want to be in something where you're not going to see 20%, 30% drawdown versus, maybe you're not going to get 50% upside in a year either, but you can still see 20% on gold to the upside. And so I do anticipate by year end, there's this triple top here. Interesting little tidbit on education is that double tops get your big pullback. So here was your high, here was your double top, that was your big pullback. Historically, here's your triple top, you get small pullbacks and then breakouts. And so again, that's kind of the game plan that we're following at this point, where I expect it to start to move up and eventually take out the highs. And I think, again, if you look at the fear of what could happen globally, de-dollarization, the fears of everything else in the economy going, gold becomes a pure play for safety, which can propel it much, much higher.
AI-driven innovation will fuel more stable crypto markets. AI-powered solutions for crypto markets will become more stable as they mitigate slippage and uncertainty, achieving deeper liquidity access and efficient predictive analysis. If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.